Hello again, everybody. This is Ken Weber, president of Weber Asset Management here in New York. I'm joined by my friend and partner, Jack Bowers. Currently, you're in, where are you now? Reno, Jack?
Back in Reno.
Yeah. Back in Reno. I know you've been doing some traveling.
Yeah, some home improvement projects. Yeah.
Yeah. So today is October 27th, 2020. It's exactly 1 week before the presidential election. And one of the reasons we're doing this today, excuse me, a number of clients have asked us over the last several days and couple of weeks actually, about the election and whether they should change their investment style or actually take money out until the election's over, that type of thing. Long-term investors, long-term clients of Weber know we don't advise doing that. Let me just point out a couple of interesting things. Over the last couple of weeks, I've seen a story in Forbes magazine written by actually Steve Forbes, where he said if Biden is elected, the economy and the stock market will sink. About a few days, maybe a week after that, Moody's Analytics came out with another report of their own saying, well, if Biden is elected, the stock market will do well and the economy will do well. And then a couple of days after that, Goldman Sachs came out with the same sort of thing that if Biden is elected, the economy and the stock market will do well. The point is, Forbes doesn't know for sure. Goldman, Moody's, they don't know for sure. Jack and Ken don't know for sure. Here's the thing, in terms of if Trump loses or Biden loses, whatever position you take, there's a chance you'll be right. And let me explain that for a moment. The stock market, as it did yesterday, plummeted, and it's recovering today. It seems to be stabilized today. So the stock market could go down and in the short run, and then as a therapeutic comes along for the pandemic and or some sort of vaccine is making progress, things will stabilize. So everybody could be right. The stock market could go down or it could go up. Most likely there'll be some combination. But if you're a Weber client, you don't want to be concerned with the next 6 months. We're talking the next 6 years, 10 years, 12 years. That's investing. And everything else is speculation and speculating, which we advise against. So that's my little spiel to get us started. Jack, you want to add or subtract anything I just said?
My view has been that given the pandemic is such an overwhelming force on the markets these days, I just don't see the election moving the needle all that much, not even for healthcare stocks. I think that, regardless of who wins the election, the focus has to be on getting the economy back on track and getting the pandemic controlled. And from that respect, everyone's interests here are aligned. So I don't expect any big moves, regardless of the outcome of the election. And the other factor to consider is that markets tend to rally on the removal of uncertainty. So regardless of who wins, if it's a decisive win, I think the markets are going to go up after the election, not down.
And of course, if, as some people are expecting or predicting, if the election is uncertain for a day or a week or a month, excuse me, sure, there will be some volatility.
Mm-hmm.
We'll get on. It'll be temporary.
Hedge funds may play the outcome too, because some people think that the market will go a certain way based on a certain outcome. And there may be hedge funds that try and start something on that and profit from it. But these are very short-term effects. I think that, even a month after the election, things are going to wash out pretty quickly. So it really doesn't make sense to throw away your long-term performance in the pursuit of, a short-term win here.
Yeah. And speaking of performance, I just want to remind certainly Weber clients and past performance is no guarantee of the future, but knock on wood, Jack, you're our chief investment strategist, and virtually all of our Weber client portfolios are equal to or ahead of the S&P, some by a significant margin. I'm talking year to date. Even our low risk models are equal to or exceeding, some of them are equal to or exceeding the S&P, which is not an appropriate benchmark for everybody. But all I'm saying is, Jack, congratulations on what so far, don't want to jinx anything, has been a very, very good year, certainly for you and for Weber clients. And you have done that in great part by leaning a bit towards growth stocks as opposed to the value stocks. And these are in quotes, growth versus value. I want you to talk to that for a moment. And let's start by just a quick definition of growth versus value. To your mind, what do those terms mean?
Growth is companies that are investing for higher growth opportunities, and they generally carry higher price to sales ratios, higher price to earnings ratios. They are oftentimes technology disruptors. Whereas value companies are slower growers who oftentimes pay out dividends to make up for the fact that they aren't growing quickly. They aren't trying to capture new markets. They're trying to hang on to what they have. They tend to benefit more when inflation and interest rates are higher because they have pricing power, unlike growth companies who generally don't because they're disrupting markets or trying to win market share. So the two stock categories oftentimes behave different, and this year, of course, it's been a very extreme difference in the way they've performed, partly because of what the Fed did, but also because the pandemic has helped most tech disruptors while it has hurt most established slow growers.
It is extreme for some people. I know I have a friend of mine who has he has money with Weber, and he has another advisor who's a value investor, and they are about 15 to 20 percentage points behind us this year, which is an extreme variance from certainly the way we invest. We're not always ahead of the S&P, that's for sure, but we're never 15 or 20 percentage points behind the S&P. So people who have really gone in deep with value have been hurt this year.
Yes.
Yeah. And so you're talking about now sort of tiptoeing into some value positions as opposed to where we were earlier in the year.
We had a very strongly growth bias position at the beginning of the year, not because I was expecting the coronavirus, but because I'm a strong believer that tech disruptors are going to redefine the market and that you want to have exposure there. So when the pandemic came along, most tech disruptors actually, benefited from everybody being forced to work at home or stay at home or do things online. So by some measures, there were several years worth of cloud computing growth and tech disruptor sales growth, simply because these companies do things online, and that's what everybody needed to do in this situation. But we've now reached kind of a valuation extreme where most of that growth is fully priced in on the growth side. And at the same time, a lot of value stocks are deeply discounted, some for good reason. The energy sector in particular, this may be the end of an era happening, and the pandemic may actually speed up the transition to renewable power and renewable stocks and electric transportation. But others.
I'll just interrupt for a second. Today's New York Times has a front page story in the business section about how some of the renewable companies, because of the pandemic, have really been hurt because their workers are sick.
That's
people who are in charge of the projects are sick or died, and that's tragic. And that's certainly going to, in the short run, 2 or 3, 5 months, 7 months, really slow down the move towards renewables.
Possibly. It's not really hurting Tesla much because they have a very young workforce and they're just kind of rolling along the way they always have.
I'll just throw in, for those of you who don't know, Jack is a Tesla fanatic. He's got every car they've ever produced.
The pickup truck, I'm very excited about that.
And I drive one Model X. I don't have a whole garage full of Jack does. Yeah. So just, you do in the newsletter certainly talk about, quote, tech disruptors. And I think this is a good opportunity for you to expand a little bit and explain what you think of as a tech disruptor.
Any company that is kind of invading an industry with a better way of doing things and capturing a lot of market share.
But specifically using technology.
Right. Tech disruptors more often tend to be users of technology as opposed to makers of technology, but there are some tech disruptors that do both. But if as Google has shown, if you come up with a better way to look things up and you really do it right, then you can create new opportunities for yourself. That's essentially what they did with a search engine that made things quicker and easier for people to find. And as a result, they could sell advertising on that.
But that, of course, is pure technologies. That's not
right. So, you know, if you went and talked to Madison Avenue before Google came along and told them, hey, you know, technology is a threat to you, they would have all laughed, you know. But here you have someone who knew the power of being able to look things up online and what it could mean, and they ran with it. And to this day, I mean, I don't use anything with Google to search things because I get really lousy results. So it's not like...
You mean you get lousy results elsewhere?
Right.
You get good results with Google, right?
Yeah, I don't use other search engines because they generate results that are not useful. Whereas Google, they have this artificial intelligence approach that looks at what people are clicking on, and then they move that stuff up to the top of their list. And so what happens now is that most of the time you search something on Google, you know, first or second link is usually what you're looking for.
I agree. Now,
not at all that way with other search engines, and it's not because it couldn't be. It's just that these folks haven't done the hard software development effort that makes it for a superior search engine. So what you have now is Google dominating like 90% of search because they're good, you know, not because they've pulled any stunts to dominate the market, but because they're good, you know. And we see this time after time with tech disruptors, you know, doing things better and capturing huge amounts of market share. We talked about Tesla earlier. You know, they're totally dominating electric car sales globally with a market share approaching 75%. I can just imagine, you know, the people who want to regulate people with market dominating positions, you know, in 20 years from now, when electrics are the car market, they'll go after Tesla, you know, on all fronts because they're big and successful because they made investments that other people were unwilling to make. So
personally, I hope Tesla does get some good, strong competition, because I have some issues with my car that I like is different, but we can argue that all day. Let me just ask you, I don't want to spend too much time. How are we going to go into value? What do you think we're going to be looking for in terms of the value side of the stock market?
Well, I think different value sectors are recovering at different rates. And I think the things that are recovering fastest right now are generally in the leisure consumer segment. So, you know, as we get a vaccine and people become more willing to do things, that's going to give a lift to the airline industry, to travel leisure companies, you know, to a lot of things that are like deeply discounted right now.
So you'll be looking for mutual funds that have overweightings in some of those areas.
That's correct. Yeah. In our select model, I'm currently favoring among value sectors the financials and the industrials. The financials are cheap because what the Fed has done is really flattened the yield curve, and so the amount of money they can make as interest margin is really low right now. Right. But that problem will solve itself once the economy comes back, because the yield curve will get steeper, and perhaps that'll happen sooner than people expect. Likewise, industrial companies are in a pretty good position right now because construction activity is moving along pretty nicely. Hasn't really been hurt in this pandemic the way it had after the financial crisis. And there's a lot of emerging opportunities with automation, with new markets. Even in the materials group, there are mining companies that are well positioned because you know, the new materials that are needed to drive a renewable economy are largely aluminum, copper, and nickel, and those are different than the types of materials that we've needed in the past. So I think, you know, the market doesn't appreciate the fact that there's a lot of winners and losers in this value arena, and the fact that an active manager can go in there and look for opportunities and probably make smarter bets than the market. Just kind of sets the stage for value funds to do well, I think, going forward, assuming the stock picking is savvy. And I think in Fidelity's case, there's a long history there.
Fidelity has a good record doing that. I only have a couple of more minutes here, Jack. You mentioned the Fed and interest rates. One of the things that we're really happy in terms of our fund selection is you've done a great job, again, knock on wood, no guarantees for the future, with the bond side of things. We've really done very, very well with our low risk models that have 20 or 40% or more in bonds. Talk to me for a minute or two about what's happening with bonds and what you foresee for the next 3 or 6 months in terms of where we are going to be on the fixed income side of things.
Well, up until recently, we've emphasized corporate bonds, which got hit a little harder because of credit risk in the pandemic, but also bounced back relatively quickly. And now we've moved more to kind of a barbell approach where with the more risky portfolios that have bonds in them, we go to a high yield position on one side and then a very conservative, either short-term or credit risk safe position on the other. And that way we get kind of the same risk that you might have with a normal bond portfolio, but at the same time, you at least have some upside opportunity with the high yield bonds, because there isn't a lot of opportunity in bonds right now. And so the main trick is trying to find it without raising risk too much. And I think we've achieved that pretty well, but we're really in a period where low yields are taking away from what bonds normally provide. And so it requires a little bit of outside the box thinking to some degree to keep that part of the portfolio working the way you want it to over the next few years. Fortunately, there's a lot of opportunities on the stock side right now, and I think we can make up for the lower returns that bonds might have simply by making savvy moves there. And so the real trick is trying to do all that and keep the risk on target. And while that has been a little bit challenging this year, I think we've largely achieved it.
You have largely achieved it. And I'll just say that with Jay Powell of the Federal Reserve saying he predicts interest rates from their perspective, they're going to keep interest rates low. And that means stocks are going to have something of an edge for the next 3, 4, or 5 years. If his words are to be believed, then I have no reason to doubt it. So if we're talking a low interest rate environment, that by itself says we should lean a little bit more towards stocks for clients, most clients, than we might normally in quote, more normal interest rate environment. Do you agree with that?
Yeah, I do. The problem, of course, is that when you put high yield bonds into a portfolio, that pushes up the risk a little bit, and you've got to compensate for that. We've largely compensated by, in some portfolios, using the negatively correlated mortgage securities fund to kind of offset some of the higher risk of high yield bonds. But you're also kind of constrained on the stock side to a lower risk stock funds. Fortunately, right now, there seem to be a lot of options there. The value stocks are the ones that have the high risk scores. The growth stocks, not so much. So I don't really feel like we are giving up anything by being constrained to lower risk stock funds in the lower risk portfolios. If that should change, then it might just be a signal that it's time to move away from the high yield bonds and more into stocks. But I think for now, I'm pretty happy with the positioning that we have.
And if and when that time comes, you and I will talk about that. We always want to keep our, our risk levels attuned to what we promised our clients. So we don't want to tilt it too much. But you and I certainly will be talking about that as we do in the future. I just want to point out to clients, you can hear that Jack knows his stuff. He doesn't spend all his time driving Teslas. He does actually go out and study and do his job as our chief investment strategist. And he definitely knows the stock market and the bond market and the mutual fund market. So Jack, I'm going to let you go.
Okay.
I think we've covered a lot of good ground here today. And for you clients who are watching, you can approach us anytime when you have a question. Good talking to you today. Good seeing you. Thank you, Jack. See you next time. Bye-bye.